Vanguard's FTSE Global All Cap ETF is finally here, and I think this is one of the more important ETF launches for UK investors in quite a while. The ticker is VALL or VOL. This is depending on where you're looking, and the fee is just 0.07%. That is half the cost of VWRP. It is cheaper than nearly every other global ETF available to UK investors. And, slightly bizarrely, it is also much cheaper than Vanguard's own FTSE Global All Cap mutual fund. So the question is this now the best one fund global portfolio for UK investors? Should people be switching? And am I going to switch personally? Because I think there are a few things that people need to know before rushing in. First of all, this is Vanguard's new FTSE Global All Cap ETF. It launched in August 2026 and it started on the London Stock Exchange shortly afterwards. It is listed on a few exchanges, but for the UK investors, the one you probably want to be looking for is the Great British Pounds listed version. That is the version called VOL. The reason that matters is because buying the Great British Pounds line can help you avoid foreign exchange fees on certain platforms. The underlying investments are still global companies and the fund's base currency is still US dollars, but you can buy and sell the ETF in pounds. Now, the main headline here is obviously the fee. The ongoing charge is 0.07%. That is ridiculously low for what this fund is trying to do. VWRP, Vanguard's FTSE All World ETF, costs 0.14%, so this new ETF is half the price. The mutual fund version of Vanguard's FTSE Global All Cap costs 0.23%. That means the ETF is less than a third of the cost. And the reason this is so interesting is that this is not a narrower or simpler fund, it's actually broader. This ETF tracks the FTSE Global All Cap Index. That means it invests in the developed markets, emerging markets, which is large companies, medium-sized companies, and small companies. It is aiming to cover around 98% of the global stock market. That is basically as close as you can get to owning the global market in one single fund. VWRP is already very diversified. It holds roughly 3,800 companies, but this new ETF could eventually hold more than 7,000 companies. The additional companies are mainly small cap stocks. This is the big difference between the two funds. VWRP gives you global large and mid-cap companies. This new FTSE Global All Cap ETF adds small caps on top of that. So if you want the broadest possible global equity exposure in one fund portfolio, this is now probably the most obvious option available to UK investors. And importantly, this is the first time we have had that in a straightforward Great British Pounds traded ETF. Before this launch, if you wanted true all-cap global diversification in ETF form, you generally had to build it yourself. You might own a global ETF and then add a global small cap ETF separately, or you might use the mutual fund version of the FTSE Global All Cap, which has always been a popular choice, but it's only really accessible on certain platforms. Now, assuming this fund does what it says on the tin, you can potentially just buy one ETF and leave it alone for decades. That is the appeal. There are a few other details worth mentioning. At the moment, there is only an accumulation version, so if you buy this ETF, dividends are automatically reinvested inside the fund rather than paid out to you as cash. There is also no distributing share class yet, at least at the launch. For most long-term investors building wealth, this is probably not a massive issue. Accumulation funds are usually easier because everything is automatically reinvested, but if you specifically want dividend income paid into your account, then this might not work for you just yet. The ETF is also domiciled in Ireland, which is standard for UK ETFs, and the base currency is US dollars, which is also completely normal. None of that should be a concern to you. Another nice detail is the share price. It launched at around £3.96 per share, which is quite low compared to some ETFs. That may not matter if your broker offers fractional shares, but if it doesn't, a lower share price means it is easier to invest smaller amounts regularly. You do not have to wait until you have enough cash to buy one expensive unit. So far, everything sounds very positive, but there are some downsides, and I think it's important to be realistic about them. The biggest one is simply that this is a new fund. Because it has just launched, it will probably be less liquid than established ETFs such as VWRP for a little while. That can mean wider spreads between the buying price and the selling price. In simple terms, the difference between what you pay to buy and what you receive if you sell could be slightly larger. That spread is an indirect cost of investing. It is not a huge concern for a long-term investor, especially if you are buying and holding, but it's still worth being aware of. New ETFs can also take time to build up their full holdings. Vanguard has suggested that the fund could offer exposure to more than 7,000 companies, which would be excellent, but I would still want to see exactly how many holdings it has after a few months, how closely it is tracking the index, and whether the spreads settle down. This is not really a criticism of the fund, it's just how new ETFs work. A fund with billions of pounds in assets, years of history, and regular trading will usually be more efficient than something that's just launched last week. But I do think these issues could disappear fairly quickly. The combination of a 0.07% fee and genuine all-cap global exposure is extremely attractive. I would be surprised if this fund doesn't become popular very quickly. The second downside is small caps themselves. Personally, I like small cap exposure. If I'm trying to own the global market, I want to own as much of it as reasonably possible. But not everyone agrees. Some investors deliberately avoid small cap stocks, particularly small cap growth companies, because they have underperformed in recent years. There is no guarantee that continues, and there is no guarantee that then suddenly they outperform either. The point is just that if you do not want small caps in your portfolio, then this fund may not actually be the perfect solution for you. You may prefer a large and mid-cap global ETF instead, or you may prefer to decide separately and when you want small cap exposure. This again is completely reasonable. Now, let's get into the main question. Should you switch? First, let's talk about switching from Vanguard's FTSE Global All Cap mutual fund. I think this is the most obvious situation where people will at least need to consider it. The mutual fund currently costs 0.23%. This ETF costs 0.07%. That's a 0.16% actual difference. Again, that does not sound huge when you say it quickly, but on a large portfolio it adds up. For example, if I have around £120,000 invested in a mutual fund across a few different accounts, moving that to this ETF would save roughly £190 to £200 per year in fees at current portfolio values. And obviously that saving grows over time if the portfolio grows. Over a few decades, compounded fee savings can make a meaningful difference to your portfolio. The performance should also be broadly similar. Both are trying to give you global all-cap exposure. Neither is trying to beat the market. The whole point is to track it as cheaply and as efficiently as possible. So on paper, paying 0.23% when you could be paying 0.07% does not make much sense. However, I'm not going to rush to switch immediately. This is still a new fund. It is a large amount of money for me personally, and I want to see a little bit more information before making the move. I want to see the number of holdings. I want to see the number of spreads. I want to see how it tracks the index, and I would like it to have at least a few months of history before I sell a very established fund to buy a brand new ETF. I do think I will probably switch later in the year if everything looks good, but I'm happy to wait a few months rather than act instantly, just to save a relatively small amount in the short term. There is also the practical point that you would need to sell the mutual fund and then buy the ETF. That means you could be out of the market for a day or two. For a long-term investor, I do not think that should be a major concern. Nobody knows what markets will do over 2 days, but the bigger picture is usually more important than trying to time a tiny gap between selling and buying. The situation is a bit more complicated if you currently hold a different global ETF, such as VWRP or an MSCI ACWI ETF. Should you sell and move into this? Maybe. But it depends. This ETF is more diversified than most alternatives because of the small cap exposure. It is also cheaper than most alternatives. If you want one global fund and you want to be as diversified as possible, then I think this is a very strong option. If you are just starting out, opening a new ISA or building a new portfolio from scratch, I think it would be very tempting to use this as your core holding, or even your only equity holding. But switching from an existing ETF is not automatically the right move. You need to think about spreads, dealing fees, and tax. Whenever you sell an ETF and buy another one, you will cross the spread twice. You sell at one price and you buy at another. If your platform charges you trading fees, that is another cost. The big one though is capital gains tax. If your investment is inside an ISA or a SIPP, that is not an issue. You can sell and buy without worrying about capital gains tax. But if you hold an ETF in a general investment account, selling could create a taxable gain. If you've made a large profit, the tax bill could be much bigger than the fee savings from moving into this ETF. In this situation, I would not automatically sell just because a cheaper fund has appeared. You might decide to keep your existing ETF and simply direct all future investments into this new Vanguard ETF instead. That way you slowly move towards the fund you prefer without triggering a large tax bill all at once. And that is probably the key point with all of this. There is no need to rush. This is a very good looking ETF. The fee is excellent, the diversification is excellent, and I think it will put a lot of pressure on other fund providers. It is also interesting that Vanguard is effectively competing with itself here. VWRP has already had fee cuts over the past year or so. It used to cost 0.22%, then it came down to 0.14%. Now this new fund is sitting at 0.07% while offering even broader diversification. So I would not be surprised if other global ETFs started cutting fees in response. And honestly, that would be great for investors. Competition is exactly what we want. For years, UK investors have looked at US investors buying VT, which gives broad global exposure at a very low cost, and thought, why do we not have an equivalent? This is probably the closest thing that we've had. It is not identical, but the principle is very similar. Own thousands of companies around the world, pay a tiny fee, keep investing, and get on with your life. That is why I think this launch matters. If you are someone who wants to build a simple, passive, globally diversified portfolio, this could be a game changer. I will keep an eye on it over the next few months, especially the holdings, the spreads, and the tracking difference. And once there is a bit more data, I will do a proper deep dive into the fund. But for now, my view is pretty simple. If you are starting from scratch, this looks like one of the best global equity ETFs for a UK investor. If you already own the mutual fund version, it is definitely worth considering a switch. But I would personally wait for a little more history first. And if you already own another global ETF, it could be worth switching, but only after considering the costs and tax implications. Let me know what you think in the comments. Are you planning to buy this? Are you going to switch from VWRP, the mutual fund, or another global ETF? Or are you happy sticking with what you already own? Thanks for watching, and I'll see you in the next one.